In this chapter, we are going to go over what options are. So there are really two main forms of options, and I'll get into them in a second here, but options are just basically the right to buy or sell a set number of shares at a fixed price. So calls give an investor the right to buy a set number of shares at a specific price. Puts give an investor the right to sell a set number of shares at a specific price. Here's some facts you should know before we kind of get into some examples here. So let's say, I'll cover the example next slide, but a strike price is the price at which you are buying calls or selling puts. Expiry date is when the option expires. Simply put, this is when the right to buy or sell shares expires. And the contract size, so each option gives the purchaser the right to buy or sell 100 shares at the stock price. So every single option that is sold is based on 100 shares. So that is something you should keep in mind. And let's kind of try to explain this with an example here. So let's give an example. So Rivian, let's just call this out as a Rivian $24 call for 8/11. That's the expiry date. So let's break this down. So the strike price is 24. The expiry date is 8/11. The contract size is for 100 shares. The stock is obviously Rivian. So that's kind of how you're going to see it. That top line, that Rivian $24 call, 8/11, that's kind of how you'll see it be talked about, and then that is what you should take for it below with the strike price, expiry date, and contract size. So what is this? So simply put, you are buying the right to purchase 100 shares of Rivian at $24, and let's say this cost $1. The true cost is $100 because it's $1 times 100 shares. So you'll always see the cost represented as it is in the top right there as $1. That's what it will show, but because there's 100 shares, it's really for $100. And then let's do a hypothetical call example here. So what happens after the price moves? So let's say we stick with that same Rivian $24 call, 8/11 strike price. 8/11 expiry date, and that cost $100. And let's say Rivian rises to $26 on 8/11. So, and you would hold to expiry. At expiry, you would receive $26 minus $24, and that's just the current price minus the strike price times 100 shares, which would be $200. And then obviously you would subtract the price you paid for the option, which would leave you with $100 profit. So that's kind of how you make moves. That's kind of how you make money off of the moves in the stock market. And then, so in our example, we held till the option expired, but you can sell really any time, right? And that price that price prior to the expiry date is affected by the option Greeks, and I'll cover those option Greeks later in this course, but just trying to get the basics down of puts and calls. So obviously you can sell a put or a call at any time prior to expiration. And then a put example here, so this is how it would read: Rivian $24 put, 8/11 expiry. Once again, strike price is 24, expiry date's 8/11, contract size is 100, and the stock is Rivian. So in a hypothetical put example, you bought the right to sell 100 shares of Rivian at $24 for $100. So in this example, let's say Rivian drops to $22, and on expiry, you let the option expire. You would receive $24, the strike price, minus the current price of the stock at $22, which would equal $200. So at expiry, you would receive at expiry, you would receive $200, and you would just subtract that from what you obviously paid for the option, and you end up with $100 in profit. And some important facts here. So you don't have to wait till expiry to sell your options. You can sell them at any time prior to the expiry date. And there's the options trading time is from 9:30 to 4 p.m. So that's just obviously the market. That's just the market timing, right? 9:30 to 4. That's when the market's open. And then index options a bit different. So they basically extend index options trading by 15 minutes. So they open up 15 minutes earlier at 9:15 and they close at 4:15. And that's only for index options like the SPY or the Dow or the DIA is really what people would buy. And then, like I said, American versus European style options, just keep this in mind. So European style options you can only exercise at expiration. American style options you can exercise any time prior to expiration. Keep in mind, European options you can still sell prior to expiration. Just keep that in mind. It's just you can't exercise the option, and exercising the option in the form of a call would just deliver you 100 shares at that strike price. Obviously same thing, but a little flipped with puts. So like I said, we're going to cover options a bit deeper later in the video, but just wanted you to understand the main concept of puts and calls for this chapter here. And then later in the course, we'll go over a bit deeper into what options actually are, and what option selling is, and what the Greeks are, which is what affects option prices. So with that being said, make sure you do that quiz. I will end this chapter here.